All right, welcome back to a new episode of Legacy Lessons with JaQ and Chan, where we focus on education, information, inspiration over a little bit of conversation. Let's go.
When all the heads in the house turn towards the door, and all the man's jaws drop to the floor, it's nothing to me, it's just how I roll. People on the dance floor starting to jump, and all the little hearts going thump, thump, thump. Nothing special to me, that's just how I roll.
All right, welcome back, everybody. I'm so excited to be sitting here again with my good friend, Dr. Chan. Welcome back, my friend.
Glad to be here, JaQ.
Yes. All right. So we are still in lovely Las Vegas. All right. So I know we've talked about some of the wonderful food you love. We've talked about shows. We talked about the sports. But have you ever gone 30 minutes outside of Vegas and spent time in the mountains?
I have not, and that's something that is on my bucket list.
All right. Well, we got to make sure we get you out to Pahrump, Nevada. I got a little family history out there. And so I just wanted to ask, I think a lot of people, when they come into Vegas, right, they get caught up in the strip and they get caught up in, of course, the excitement of Las Vegas. But there's so many beautiful gems about 10, 20, 30 minutes outside, like Lake Las Vegas and things like that. So anyway, I just figured I would see if you, ever venture away from the strip.
No, we got to do it. We got to do it.
Good stuff. Well, today I really wanted to take some time and educate our audience around, some technical terms around the economy. I think, it's important that, as we educate our audience on these legacy lessons, we first start off by just kind of laying some of the groundwork to make sure everyone understands some of the terms. And then we can get into some of the meat, some of the information. And as always, I'm sure we'll leave them with a little bit of inspiration. Fair enough?
Fair enough.
All right, very good. So let's go super, super basic. All right, so for people who have never even heard the term global economy, recession, inflation, can you just start off by really breaking down some of those just kind of key definitions, maybe just starting with overall, what does it mean? First of all, what is a global economy? In short, what does it mean to say, I'm following the global economy? And then let's talk about inflation and recession. Define those for me.
Well, the global economy is looking at the production of all the economies and all the countries in the entire world. The International Monetary Fund and the World Bank do a good job at estimating economic growth for all the countries around the world. And so after they do that, they take a composite of all those growth rates, and guess what they do? They estimate a growth rate for the entire global economy. Now, the average person doesn't have time to estimate and run models for 200 plus countries. So I actually wrote a Substack article on this very same topic. And I said the best way to estimate what global economic growth is to look at all the IMF and World Bank statistics and then use that into a model to forecast what world economic growth is going to be into the future. And I find that is a pretty good strategy, and it saves certainly the work of several hundred economists, and certainly gives you a really good perspective when you're investing. Because when you're investing, you want to have a diversified portfolio, and these estimates allow you to decide whether you want to invest in Latin America, whether you invest in Europe, whether you invest in Asia or the United States, and you can certainly compare these things. And what I did in that Substack article, which I invite people to look under the People's Economist under Anthony Chan, is to really show that the superiority of those both organizations, you'll see it there, and you will then use the estimates of the best organization to estimate the global economic growth. And I'll give you a little pearl of wisdom, JaQ, and that is that whenever global economic growth is below 2.5%, that usually tells you that there's some trouble on the Western front. Some economies are going to be experiencing sluggish economic growth, or what we're going to define as a recession, and some economies are going to be doing okay. Whenever global economic growth is in excess of 2.5%, you can pretty much sit back and say, the world is not doing so badly. And by the way, just less than a week ago, I did a national global television segment where I talked about the latest updates from the International Monetary Fund. And guess what? Good news. global economic growth in 2024 is expected to exceed 2.5%. So the major economies in the United States, even to some extent China, and Europe, which, by the way, just skirted the possibility of having the whole Eurozone go into a recession, may be able to avoid it because the IMF is projecting global economic growth will be in excess of 2.5%.
Wow. So that's really good to know. And I really want to go back to your Substack article because I know you recently put that out, and we're going to dig into that momentarily. Thank you for defining that for our listeners. And so with that, I want you to also help us to understand the term recession. We hear that bounced around. We've heard, we might be in one. We're already in one. We've been in one. We know what happened back in '08. So help us to understand, especially as we think about, '08, and as we think about some of the things that we're forecasting, even in commercial real estate, here in 2024 and beyond. Does that all tie into a recession? What is a recession? And are we in one? Are we about to be in one? Help me out.
All right. Well, the recession is obviously a politicized term. And of course, both political parties sometimes want the economy to be in a recession if they're the opposing party so they can be reelected. And that goes true for both political parties. One of the things that I pride myself in the Substack articles that I write is that they're completely nonpartisan. They give you all the facts and they let you decide. Doesn't take any sides on any side of the political aisle. But in terms of what is a recession, the good news is that it's not determined by whoever's in power in the White House. It's determined by the National Bureau of Economic Research. They're completely nonpartisan. They have equal number of Democrats and Republicans. And a rule of thumb is that if real GDP, or the total production in the economy, declines for 2 consecutive quarters, on average, we're probably in a recession. I say a rule of thumb, JaQ, because that's not the real definition. The real definition is that they look at a whole bunch of economic variables, whether it's industrial production, whether it's real GDP, whether it's employment, whether it's personal income, taking out transfer payments. And transfer payments are the monies that government give people without having to work. Okay. So things like Social Security, welfare payments, food stamp payments, they take all that out. And if that is declining, then that is one of the variables, in addition to the other ones I've mentioned, that if that happens for 6 months in a row, consecutive or longer, then that defines a recession. And so far, we really have not seen the National Bureau of Economic Research telling us there's anything close to a recession, because we're seeing even the rule of thumb is not being coming into focus. In the fourth quarter, we just got the numbers suggesting that economic growth in the fourth quarter came in at plus 3.3%. That's very far away from a negative number. And by the way, JaQ, just so you get a rule of thumb, the average growth in any given calendar quarter for the U.S. economy over the last 30, 40, 50 years, 1.8%. So any number above 1.8%, we're doing better than average. And that 3.3%, as you can tell, was almost twice as fast as the number comes in just on an average basis. Yeah. And then for the first quarter, we don't have data for that. You have the Atlanta Federal Reserve that has a really good model that forecasts economic growth. And I say a good model because what is the gold standard for forecasting? It's the Blue Chip Consensus Economic Panel. It's composed of the top 50 economists in the United States, and they forecast real GDP. I'm very happy to say that I've been lucky for the last 30 years. I've been a member of that Blue Chip Consensus Panel. And so I submit economic forecasts every single month to the Blue Chip forecast, the top 50 economists in the United States. And right now, the Atlanta Federal Reserve, which puts out that number, you might think that I'm going to tout the Blue Chip Consensus because I'm a member, but I've actually done real hard economic research, and I did it in one of my Substack articles, and I found that the Atlanta Federal Reserve model, which is extensive, has a better track record than the Blue Chip Indicator. Yeah. And they historically are much better. Now, to get the real breadth of how good that model is, you want to use the last estimate of that model because it changes every time a number comes out. And you compare it to what the actual number is when the government releases it. And when you do that, it has a superior track record. Now, JaQ, you might be curious then to know or ask, what is that number likely to be in the first quarter? Because now the fourth quarter is behind us. And the latest number is that the Atlanta Federal Reserve is forecasting 4.2% economic growth in the first calendar quarter of 2024. We won't know that number until April of 2024, but already we have a sneak preview and it's telling us we are very far away from anything called a recession. Now, I know investors talk to wealth managers and advisors, and they're always so afraid of investing because if a recession comes, like you mentioned earlier, you might see another 2007, 2008. The stock market takes a big plunge. Why invest in the stock market if there's any chance of a recession? In fact, some investors just completely run away and don't want to invest at all because they're so afraid of recession. The good news, JaQ, is that research that I've done finds that expansions, and that's when the stock market goes up, usually last on average 3 to 4 times longer than recessions. In fact, the average recession is less than a year. That is why over long periods of time, when I say long, 5 years or longer, you usually make money in the stock market. You don't lose because the good times are 3 to 4 times longer than the bad times. So on average, the stock market goes up. On average, the S&P 500 goes up about 7.5% per year over long periods of time. Because again, the good times are better. The recessions are only a short period of time.
Oh, that's awesome. And so what you really have done is really just helped our listeners and our audience understand the different cycles, that happen from, you mentioned expansion, right? That's when we're kind of coming out of that recession and we're starting to head back up. And then what is it? Then we peak out. Right, but then there's what they call the trough. Did I say that correct?
That's right. That's when the economic expansion hits the bottom. That's the trough. That's correct.
That's when we hit the bottom. And so how does all this tie into like inflation? I mean, of course, over these last 3+ years since COVID, we've seen prices definitely go up. I mean, I'm seeing it at the gas station. I'm seeing it at the grocery store. We're seeing it, just in everyday purchases. And so, help us tie all that together as far as the inflation numbers and really how everything you just said really ties into what we're seeing from a consumer price perspective as well.
You're spot on, JaQ. We saw the consumer price index hit a peak of 9.1% in June of 2022. And everybody panicked because that's 9% inflation. Of course, during the Carter administration, we saw inflation that was double digits. And so inflation was much higher than we saw in June of 2022. But because we hadn't seen inflation that high in decades, everybody panicked. The good news is that inflation has now come down. It's below 4%. But since the 1980s, we've learned how to measure inflation in different ways, more accurate ways. Now the Federal Reserve likes to look at the personal consumption deflator in formulating monetary policy, as opposed to the consumer price index. Now, real basic, why the difference? Because the consumer price index has a fixed basket. And so they measure prices from month to month, year to year, based on products that we buy. The reality is that when the price of one product goes up, I did a Substack article on this very same topic. Let's say the price of strawberries goes up. Well, we may stop buying strawberries and we may buy blueberries. But if you're looking at the consumer price index, it's got weights for strawberries, it's got weights for blueberries. But even if people buy less strawberries and more blueberries, we're not capturing that. The personal consumption deflator is very good at that because it looks at the change in taste, change in demand. So we're buying more blueberries. Guess what? We're going to weigh the blueberries more and the strawberries a lot less. And that inflation number in the latest month was up 2.6% year over year. So you can see that inflation is coming down. And we also know that the central bank likes to take out food and energy, not because people don't eat or people don't drive or don't use energy, but because those are very volatile components. And so that is the reason why the Federal Reserve focuses on that 2.6% number that I mentioned with the personal consumption deflator, taking out food and energy. If you put back food and energy, it's up almost 3%, 2.9%. But again, the numbers are getting very, very close to the 2% target that the Federal Reserve wants. And I did some more research in another Substack article, again, under the People's Economist of Anthony Chan. And guess what I found? I found that if you look at the core personal consumption deflator, taking out food and energy, and you look at it on an annualized basis over the last 6 months, that number is below 2%. So we've made it. And if you look at it on a 3-month annualized basis, it's also below 2%. So we've made it. The only measure that I can look at that says we're still not there, that if the kids are in the minivan, the parents have to say we're not there yet, it's the 12-month year over year. But again, because we're there with the 3-month and 6-month, mathematically, we're getting very, very close, and we should get there very soon.
Very good. Well, I know we talked a little bit about, of course, now the recession, inflation, the global economy, but you mentioned the people stack, right? And so let's go to our inspirational moment. What inspired you to start that website? So we're going to dig into your latest article, but I know you started this several years ago.
3 years ago.
3 years ago it's been. And so, before we dig into the latest one that you produced earlier, actually this year, back in January, tell me actually what inspired you to start this newsletter. And again, where can people find it?
You can look it up under Substack.com.
Okay.
And you go and put my name in, Anthony Chan, or put in the People's Economist. And what inspired me to write this, JaQ, is I was an early educator. I was a professor of economics and finance. And so I didn't think that there was a real forum out there for people to explain economic trends or economic phenomena in very simple terms that everybody could understand. I also found that when you look at a lot of economic articles, people always have an agenda. They're trying to push either the liberal or the conservative side. And what I vowed to do with this website, and by the way, nobody else does this, is to basically provide the reader with the facts. Yeah. That's those facts supporting the Republican arguments that you hear and the Democratic arguments that you hear, and then let the reader decide. Well, I think that a lot of people that I talk to say they're very tired of reading things that basically tell them how to think. Wow. I think everybody that reads my articles on Substack are adults. They should be able to decide whether they want to support Democrats or whether they want to support Republicans. And this Substack newsletter allows you to make those kind of decisions. So that's what really prompted me to give people the information they need that they don't find from either the right-wing media or the left-wing media, and they can make decisions on their own.
Oh, wonderful. Wonderful. So, you've been doing this for the last 3 years. And so, one, how often are you producing this newsletter? And then two, what was the inspiration about the latest newsletter that features Mariah Carey?
Oh, that's right. Well, I have thousands of subscribers to that newsletter, so it just continues to inspire me to do more. And how often do I put out? On average, every year, about 52 issues a year. Okay, so they average about once a week.
All right.
Sometimes it's a little bit less than once a week. Sometimes it's more than once a week. I guess the key is that I only write an article when there's a hot economic topic out there. And this latest article, or one of the recent articles that I wrote that had Mariah Carey as a feature, because as you all know, she has that classic song, All I Want for Christmas Is You. And then she, right after Thanksgiving, she always says, it's time. And everybody gets excited and starts listening to one of her best-selling songs of the year. Well, in the economic area, every year in August, the last week in August, it becomes that same situation. It's time because that's when the government tells you that there is going to be a revision in the employment statistics through the March of that same year. So let's say in August of 2023, they will tell you or give you an estimate of how many jobs will be revised either up or down. Now, politically, this is political drama. Because if they tell you we overestimated the jobs, as they did in August of 2023 by 306,000, everybody starts saying, that means that the Washington administration is secretly overestimating jobs because they want to win an election. The prior year really got exciting, JaQ, because guess what? They told you that they overestimated the number of jobs. The Philadelphia Federal Reserve then came out with a study that actually went ahead and looked at more numbers and created a model, and they said that the administration had overestimated the jobs by 1.1 million. You can see how much drama you would get. One senator actually went ahead and wanted to bring the head of the Bureau of Labor Statistics to Congress to testify why they were secretly overestimating the number of jobs. The reality is that every year they do these revisions because they get more data from taxes, from the people that file unemployment insurance, and that's how they get the new numbers. There is no secret stuff going on. That 1.1 million overestimate that everybody started to talk about, guess what happened, JaQ? When those numbers came out, it turned out it wasn't even an overestimate. That was actually an underestimate, and that we had created more jobs, not less jobs than the government originally told you. In fact, it got so controversial that even the Federal Reserve Bank of Philadelphia, when they put out that study, they took it offline. They didn't even want people to look at it anymore because it was so politicized that it was crazy. This past year, in August of 2023, the same thing happened again. It wasn't 1.1 million, but the government said there's a possibility that we overestimated the numbers by 306,000 jobs. Again, the alarm bells rang. We are overestimating to help the political. And again, this is so flagrant that I did a study that looked at all the presidential administrations since the data has been coming out, and I really couldn't find much difference in terms of either Democrats or Republicans. You can see my work is nonpartisan. I wanted to see, because people are so nervous about this, are the Republicans overestimating jobs or the Democrats doing it? And again, I couldn't find any evidence that either political party is doing it. And in case you're curious and at the edge of your seats, that 306,000 overestimate turned out to be a lot smaller. It turned out to be less than 300,000, about 266,000 overestimate. And by the way, guess what? We saw that in the last 2 months, we had an upward revision in jobs. We just got, as we speak, about a couple of hours ago, the latest employment numbers for the month of January of 2023. And that number, according to the consensus, turned out to be almost 168,000 stronger. So when you look at the upward revisions for November, for December, and the fact that the number came in stronger, that small number of 266,000 overestimate is completely offset. So you can see this is not a politically motivated situation on the part of Democrats or Republicans. So I'm giving both political parties a free pass. These are numbers that get revised because the government gets more data. In fact, on most economic statistics that we get, and people say, oh, the government doesn't know what they're doing, whether it's retail sales, whether it's employment, I got a little secret for you. In many instances, they only have 50% or less of the data that they need to make a real estimate. So when they revise it, it's not because they were trying to hide something. It's that now they have more economic data so they can give you a better number.
No, this is good. So can you help us understand the role of the BLS, the Bureau of Labor Statistics, for our listeners? Like, what is their role, in how often should we be looking at these numbers? How often do these numbers come out? Help us understand.
All these numbers come out in different intervals. The Bureau of Labor Statistics, again, they're non-biased. They have Democrats, they got Republicans working there. There's no political bias. And they put out numbers every month for inflation. They put out numbers the consumer price index. Every month they also put out numbers on industrial production. That is, how is the manufacturing sector doing? A whole slew of economic numbers. The Bureau of Economic Analysis puts out numbers on the output of the United States. For example, GDP, that tells you how much was produced in the entire United States. They put those every couple of months because those are quarterly numbers, not monthly numbers. And again, they also revise those numbers because when they put out the first estimate, the numbers are not including all the information. And then another dirty little secret that people don't know, and that is that since COVID, because you were talking about COVID, the amount of people that contribute information to these agencies has actually plunged. Because again, people are now, they were distracted during COVID. They stopped reporting. They were distracted with other things, and they never really went back. So today, the numbers, believe it or not, are actually less accurate now than they were before. The good news is that there are other companies out there that are stepping in to be able to provide data. There's one company called BrightQuery that that I also work with, and they actually look at all the tax jurisdictions out there, and they have data for all the establishments all over the United States, and they can estimate jobs. And it's not just them, but more people are starting to look at alternative alternative data sources that, believe it or not, are better than the government because we're starving them. We're not giving them a lot of resources to publish these things. And so we're going to see that over time, private entities are going to be able to give us economic data that's a lot more valuable and a lot more accurate than the government is giving us.
You know, you've given us a lot of information, but I'm actually going to throw you a curveball, and I'm going to shift gears for 2 seconds, Dr. Chan. For people that want to actually get in this industry and become a future Dr. Chan, who want to become a future economist. I think about, we had a chance to spend some time with a dear friend yesterday, and he was just raving about how much he loves your Substack and how he leverages that really in his day-to-day work. And, you know, he's a young man, diverse man in the industry. I'm in his 20s. And again, I look at him as a future economist, right? And so, you know, as you think about all of what you just said, and, you know, you're 35 plus years in this industry, you know, what advice would you give for, you know, someone that looks like us, to, you know, that might want to say, I want to know all about that stuff. How do I get in this industry? What should I be studying? What colleges, you know, courses should I be taking? Really, what is the path?
Well, the path is pretty straightforward, JaQ. Economics has become more mathematical, uses more statistics. So somebody that's going to college has to take a lot of mathematics, calculus, geometry, all the matrix algebra, all that stuff, differential equations. They also need to be really good at statistics, and then they can really understand how the economic profession is developing. In economics, you have several layers. You can sort of get a bachelor's degree in economics. At that point, you'll be sort of like a research assistant. You can get a master's degree, and that puts you a little bit higher. But if you really want to be an economist, be able to analyze models, analyze complex situations, you probably have to go that next step and probably go ahead and get the PhD. So it's possible to do all this stuff in a very short period of time if you go straight through and you don't work and you're going straight through school, or you can actually do it a little bit more leisurely by working and going to school at the same time. And in terms of where can you go to school, the profession has become so advanced today that if you really work really, really hard, you don't necessarily have to go to only 1 or 2 schools to become very good at this. That was probably true more maybe 40 or 50 years ago, but today the profession is pretty advanced and it's pretty straightforward. So you can get a pretty good education almost any place you go as long as you work really, really hard, you got good mentors, and you really decide for yourself that this is exactly what you want to do. But the important thing, JaQ, is that you understand that there are different levels. You can really get very excited about economics. That doesn't mean you have to get a PhD, but you can be really excited and decide that you want to work with somebody like a research assistant. You want to go ahead and take it to that next level and get a master's in economics, or even take it to the final level and get a PhD. So the different levels of enthusiasm that I recommend.
Oh, that's really good. No, so I think it's important, again, because as we think about, you know, the work that you do, the work that I do, you know, we want to be able to also introduce these fields, you know, as career paths for our next generation. And you shared a lot of great information today. And for some folks, they probably were like, how do I, you know, is that even possible for me to understand, right? And so thank you for, as always, making it so that it's digestible for all of us to understand. And at the same time, I also want people to understand that this career path is definitely something that is, you know, attainable with, like you say, the right work ethic, the right, you know, career opportunities, and a great mentor. So thank you for being a mentor for so many of us, so many of our colleagues over the last 30 plus years. And of course, you know, my goal with Legacy Lessons and bringing education and information and inspiration over conversation is so that we can help provide some of that digital mentorship as well to our audience. So thank you so much. Tell us again how we can follow you on Substack. Where can we get your information? Let's go.
Please follow me on LinkedIn. I'm happy and excited that as we speak, I have about 9,000 followers,
Woo!
but I need more.
Yes.
Because I want to be able to spread all this information. I want wealth managers to become more conversant in economics. Reading my Substack newsletter, which, by the way, is free if people are excited about it. because it gives you sort of the ammunition you need to understand what's going on in the economy. And it's different from most of the other newsletters, which try to give you complex things. My job is to simplify it, make it digestible so that the average person can understand what's going on in the economy without having to become an economist.
That's right. There you go. All right. Thank you again, Dr. Chan. And we just want to thank our audience again for joining us for another episode of Legacy Lessons with JaQ and Chan, where our goal is to provide you education, inspiration, and information over a little bit of conversation. Be blessed.